the way we are looking at it is that definitely geopolitics is going to drive a rally to risk assets. So we're looking at, in terms of safe havens, we have seen gold prices higher this morning. We're also seeing a stronger US dollar. Now, when we are looking at our own positioning, we held our tactical asset allocation meeting just earlier this week. And what we felt is that definitely while we are neutral gold, there is always risk to the upside with currently what's happening geopolitically, also with oil and energy prices. Again, while there has been a bit of stability recently because OPEC does have some room capacity to add back. But we are definitely going to see a tick up in oil prices with the Strait of Hormuz, a very important conduit for oil. We are seeing a sell-off in global equities, and we are very close to neutral in terms of our equity allocation, both developed and emerging markets. And a 5 to 10% correction every year, twice a year, is pretty normal. And again, it looks like this time it's geopolitics that is taking the market down.
Indeed. So, Anita, as you and your team assess the geopolitical risk right now and the potential for further escalation in the region, how should investors be positioning and what is the bank doing in response?
Okay, so at this point, very clearly, diversification is important, and that's been the story for the last 25 years. Have a diversified portfolio. So what we are seeing in the market is that, if you have a combination of different regions, starting from developed markets, the US has always been a safe haven, always, been the preferred choice for investors over the last couple of decades. Again, that remains because the companies there, many of them are global companies. So US, we are at this point equal weight, neutral, and I would stay with that. Still had a preference for Japan, though at this point we're seeing a very, close correlation between all the three developed market equity indices performing similarly. Europe a little better on interest rate cuts expected in June. Again, we are saying add to emerging markets, keep your portfolio with a combination of developed and emerging market equities. The growth is coming out of, at this point, in terms of upwards earning revisions, the US, Japan, India, the UAE. So these are the four regions that we continue to favor. Diversification, again, in the sense that in terms of the fixed income, our preference is, of course, for sovereign bonds at this point, the safer parts of the market. So your portfolio should have the right combination of fixed income, equity, and alternative assets in terms of gold and energy. Again, I reiterate that we would also very, very highly recommend staying with quality, that is companies, both on the credit as well as their equity front, which are very strong future earning prospects.